The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, on Wednesday, we saw a grain market trade that slipped moderately lower. Livestock action, cattle futures mixed as we wait more cash trade this week. Hog market had a nice rally. Plenty of volatility still in the outside markets. We're nearing the end of the month. We got plenty of back and forth moves that we're going to have to watch outside market wise, chart related action, weather forecasts, and more. Let's dive in and talk about it. Joining us, Mike Zuzolo with Global Commodity Analytics. Mike, good to catch up with you again this week. How is it almost the end of February already?
How is it that we're getting ready to break wheat dormancy because of the temperature fluctuations? I mean, I don't think the trade has really looked at that at all at this point, Jesse, with the 90 to 100 degree temperature fluctuations in what, a 48 or 60 hour time period. But you're right. We're right up against the USDA Ag Outlook Forum, getting ready for the acreage numbers for corn and beans and finishing up on the crop insurance base prices. So a lot coming together here.
Absolutely. Well, let's lean into the weather side of this. You rightfully so, you brought up the temperature swings and wheat dormancy coming out of dormancy here very soon. And I want to bring up just the drought conversation, because we haven't seen a whole lot of moisture in the northern plains, the central plains, even some areas, and the southwest. So set up our conversation for us today and give us some of your thoughts, what you're seeing when it comes to U.S. weather right now.
I don't know how else to view the wheat break to the downside other than end of the month profit taking and what we oftentimes see before major USDA numbers, what we would call in the 80s and 90s, that song, the safety dance that the trade does by getting into spreads and liquidating longs. When you can't seem to remember just a week or so ago, you were talking about substantial drought in Russia and Ukraine's wheat belt, as well as the United States wheat belt. And this map of the 0 to 100 centimeter soil moisture levels at that depth really shows the situation as very critical as we do warm up. And I think, simply put, Jesse, this trade has just walked into a mindset of taking profit for the reasons I just discussed, and also are betting on the come, because there are several weather forecast services out there suggesting March is going to be a light switch of moisture, and we're going to turn from relatively cold and dry to above normal temps and above normal precip. So I will say right now, as the way I look at this market, not knowing what USDA is going to say, not knowing what President Trump's going to say in March on the tariff situation, wheat is getting into an extreme undervalue level if we don't get the rains and the weather forecast that the trade, I think, is starting to feel and feel like it's going to happen. And I can say this map pales in comparison to how the Baltic states look right now and the Russian-Ukrainian situation is right now. I'm going to serve the same map up to my clients and subscribers tonight with your video, but it's covered with dark brown and red right now. So I'm just sitting here thinking this is not weather related.
All right. Well, let's take a look at the weekly SRW chart and see what you're tracking here. To put some of this into more perspective, we got a lot of charts and spreads to look at here today on the show. So walk me through specifically SRW complex, what you're watching.
Yeah, this is not about the currencies, because the Russian ruble is hitting its highest level in several months. The Russian high pro wheat price at the export terminal that I follow, over $250 US a ton. That takes you up to levels not seen since that major high in the second quarter of 2023, or excuse me, of 2024. You're dealing with the situation where that 617 and a quarter level, where the orange arrow and number is, we went up and matched that. That was last September, October levels. We didn't go through that. It was a brick wall. So that's going to be our new major resistance line, is around 620 SRW. We break through that on a weekly close, then we open the upside up quite a bit. And that's why I'm saying what I'm saying right now. But other than that, the only thing you need to see in this chart is we really tried hard to get above the 100-week moving average, did a good job, weekly close above. And then we went down and checked that trend line, which was also the 100-week moving average, gave up both of those. And that's why I think a lot of this is technically driven, and the funds are probably building up a bigger net short position after having winded down some of their and cut some of their big net short position over the past week or so.
Yeah, I mentioned plenty of volatility in the outside market space as well. And you and I have been tracking the relationship between SRW wheat and copper here over the last several months. And looking at the updated chart again, seems like the two are continuing to track pretty closely with one another, Mike.
Yeah, and even more importantly, even though the WTI crude's made a new 2025 low this week, we are seeing the copper not really find any kind of weakness in this weekly trade. And this is even though President Trump has come out and talked about copper tariffs now at midweek, but we have not seen the copper give way. So you can't blame this on China, and you can't blame this on copper when it comes to this chart. They're still carrying a very strong price relationship on a 6-week basis of 88% positive. But this week, they've been completely different. If you probably ran a 1-week correlation, it'd probably be negative 90% right now.
Well, and I find this interesting here when you look at this wheat complex, and we've talked so many times about wheat needing to be the leader here. So I want to rope this into perspective of corn and soy. You got a chart, we're looking at the new crop soybean corn ratio. And you mentioned the outlook forum earlier. I just wonder how some of the moves in this wheat market could potentially be affecting corn and soy when you look at charts and look at the technicals and fundamentals, Mike.
I'm really glad you asked that, because we never talk before we go on air about what we're going to talk about. We just go. And this is a really important chart, because you can see by the Nove beans gaining on the Dees corn this week and part of last week, the trade is pricing in all of these bigger corn acres ahead of the Ag Forum, which starts on Thursday morning. So we see that linkage very clearly, that you're buying back your short Nove beans and selling back your long Dees corn. But that is only part of the story, because what that means when it comes to the wheat market continuing to go down, and it, I think, is still the leader, is the spreads by themselves. The corn spreads by themselves, the bean spreads by themselves show quite a bit of different mindset. And it still makes me think that the wheat market is very important to the corn market, especially when it comes to upward price bias. And so the bean market looks better in the new crop, but I would argue as we get ready for the March first notice day here at the end of the week as well, the March bean futures look much more susceptible to a break to the downside, in my opinion, Jesse, just because of the spreads. And I know the spreads are partly, like I said, a safety dance type mindset for the traders ahead of big numbers.
Well, and I want to look at those individual spreads here and talk about those in a second, but I do want to throw this thought to you. With the Outlook Forum, all the acreage talk, there's been various private estimates that have been calling for 94.5, 95 million acres of corn. I mean, you get into some of those levels, Mike. We know the U.S. farmer likes to plant corn, but that is a lot of corn acres. And a number like that, if we start and continue to get big numbers like that, kind of concerns me for these markets.
Yeah, I agree. I think you're in a situation that this market has got to realize the negative balance sheets that we're going to be running in 2025, even with the crop insurance prices probably improving some over the second half of February. But you can't really make any money in corn or beans. And so what the trade is starting to say is, well, corn's the least best option. Why? Because the yields in corn have been better in comparison to the soybeans for most of the farmers in the primary growing belt the past year, maybe 2 years. But I think at the end of the day, it's about the finances, it's about the loans, it's about what your farm credits and your banks are going to say to you as far as how much you're going to string yourself out as far as input costs. So I'm like you. It's hard for me to get above the 23, 24 mindset of, around that 94 million corn acreage number. That's exactly where I'm at right now, is 94. I can go higher, if the November beans take a big nosedive between now and planting, or D's corn takes a big jump. But again, I think that's got to be led by the wheat at this stage, because the wheat corn spread in the front end complex right now, Jesse, is saying buy wheat for feed. We're below $1 in SRW minus corn. Buy wheat for feed, especially if you're in Asia. So that right there, between the livestock and the HPAI and the uncertainty about the ethanol policy, and that's going to be number 2 on my list when it comes to the Ag Forum numbers. Acres number 1, but ethanol biofuel policy number 2. When I give counsel and clients ask me about what they should plan in 2025, I'm much more leery about the corn because of susceptibility of the biofuel and the ethanol. And we saw that again on Wednesday. Production down a little bit, but the stocks continue to go up, and margins are really tough in ethanol and have been for quite some time.
We're talking with Mike Zuzolo from Global Commodity Analytics here today on Market Talk. Let's take a look at some of these spreads that you referenced earlier. Let's start with the July-December corn spread. As you mentioned, we got first notice day. We're going to start rolling to May, July contracts, rolled crop, and then, of course, working with December new crop here. What are you seeing here? And I'll throw out the caveat to listeners that you have a note here about maybe South American drought at play in this spread. Talk about that.
Yeah, I don't think we're done playing the South American drought, and I think we probably switched from Argentina's drought over to getting caught up on the safrinha corn crop, which is a much bigger play. We've talked about that. My South American colleague got a hold of me today and said he thinks they're still about 10 points behind last year at this time with safrinha corn planting. This spread to me is probably one of the most important spreads I can remember, and probably since 2013, after the big drought year, and then China throwing out the U.S. corn because of the one type of MIR 162 or whatever it was. It was just an acronym from Hades when it came to what it did to our corn market and to our spreads. But right now, keep in mind the March, as you say, first notice days this week, at the end of the week, we've got a March price that's 15 cents cheaper than the soon-to-be May, which is going to take on the higher level of volume and open interest by the trade. And so we're already carrying a carrying charge market and a premium in the May over the March. But you go to the July D's, it's the exact opposite. You're carrying a 31 cent, 32 cent premium in July over D's. The trade and the funds in particular, I think, are thinking that this market is going to still be very tight on supplies and still have a lot of demand to have to soak up, because South America is not going to be able to do a lot of exporting between now and May and June at this point, Jesse. So this spread went down to one of the 2 major support lines. And you notice after the third quarter of last year, that downward channel gave way to an uptrend. So we're testing one of the key backbones of this chart, and so far it's held. If at the end of this week, though, and Monday of next week, when we've digested a lot more about the Agricultural Outlook Forum and we get any kind of new news on the tariffs, if we fall below that 30 cent level and take out the green trend line, we can slip quite a bit. And it would not surprise me to see that if we indeed do see a weakening demand mindset and delivery in March futures not go well. So we're really on a key level here on the corn. This is one of the major reasons why I haven't sold any 2025 corn yet, because as long as the July is pulling the D's higher, I don't need to worry as much about the D's losing a lot of premium.
All right, let's talk about the July-November soybean spread. What are you tracking on the soy side of the ledger, Mike?
Yeah, completely different looking spread. We lost the major backbone and the white uptrending trend line chart there, and we've now gone back below that 15, 16 cent level, which was kind of a channel high level back in the later part of 2024. We're now only 11 cents premium in July beans versus November. It would not surprise me that this spread goes into a carrying charge where July goes discount to November as the March goes into delivery here at the end of this week. But I could be wrong, and that's what I love about these spreads this past 6 months. They've done a really good job on suggesting whether you need to be an aggressive seller or not. So that's why I'm bringing it to the people here on the video today, and hoping that you get a 2-week trial and sign up during this time period, because these are some of the most important features of this market that I think very few people track.
That website, globalcomresearch.com, globalcom with two M's, research.com is where you can find Mike. And we'll talk more about that in a minute. Let's go over to the livestock complex. Let's talk cattle. Had a bit of a pullback, of course, futures wise, yet Monday, Tuesday, decent rally. Felt like a bit of a consolidation day in cattle futures Wednesday as we kind of await what's going to happen with cash trade. What are you watching first on the feeder cattle side, Mike?
Yeah, coming off the cattle on feed report a week ago, or on Friday of last week, we saw a follow through to the upside, and we got some distance in both fat cattle and feeder cattle away from some key support levels. The problem that's happened here since now going into a midweek mindset, Jesse, is the fat cattle have not found any kind of cash price, and they're drifting and they can't hold gains. And it's almost as though after the cattle on feed report, the packers are pulling bids to improve their margins, is kind of the language that I see in the price action right now. And it would make sense from a standpoint that the marketings were a little sloppy on that cattle on feed report. The fats got the worst side of the report, if you ask me. And there's plenty of nearby large weight feeders that the cattle on feed report showed us that we've got plenty of fat cattle coming to market. So weekly kill numbers will be very important to me on Friday to see if that thought, if that mindset is shown to be accurate with a very light kill number, that the packers really just kind of walked away and want to back up cattle more. So if that's the case, this chart here, this weekly feeder chart, having that all in mind is suggesting to me, let's go up and maybe try for a double top. Let's go up and meet where the CME cash index is there, and the flat orange line at about 279.44. That's the last one on the Mercantile website. Let's see if we can hit a double top and see what happens after that. In the meantime, we're just trying to pull the fat cattle up if we're the feeder cattle market.
Well, and you mentioned pulling fat cattle up. Let's talk about that feeder fat spread. I thought it was interesting. On Tuesday, you saw a big jump in feeder futures while the fats were up somewhat, but it just felt like that spread started to widen out a bit again. And feeders are kind of trying to do the whole, hang on, little brother, fat cattle, kind of mindset here. It feels like, and trying to pull them along, Mike. I don't know how else to say it. I mean, are you seeing that in this spread right now when you look at the lead month cattle contracts?
Yeah, and we don't have time to talk about it in detail, but I'm going to talk a lot more about it in the coming week or so with clients and subscribers, Jesse. But the thing I love about this spread, and the compliance people would say to me, look, every year's different, and they're right. And so you can't rely upon cycles, but you can keep track of them. And this seems to be another year where a cycle low has been put in on the feeder fat spread. Feeders start to gain against the fats, and this would be like the 7th or 8th year that in Q1, in early Q2, somewhere in that time period, the feeder cattle find a low against the fat cattle. And that's really important to have right now, because everybody's looking at these high-priced cash feeder cattle, suggesting out there in the market that we're not done with this rally. So this was important that the feeders started to gain on the fats. We're back up to 75.50 premium. I would love it if we would get back up to around $80. Notice in 2014, we got up to about $80 feeders premium to the fat cattle. So that's kind of a bell to be rung here. If we get up around $80, can we really ask a lot more out of the feeder cattle? And then that in turn keeps me in the mindset, let's get those feeders hedged if that double top on that weekly chart holds, or even if we can go through it a little bit. So I'm really primed to get some feeders hedged, because I just don't like the way the fat cattle are acting right now.
All right, Mike. I should ask you about the hog market too before we close out. We've talked before about that pork and bean trade. It seemed like it diverged a little bit Wednesday, but I have to wonder if it was just finally a technical type of bounce in hog futures. What do you think?
Yeah, I think the hogs are still stuck in China for the most part. The cutout is still weakening for the most part. It's not strengthening. It's not giving up the ghost though. So it's stable, but I think China is still the bear in the market. The beans probably are looking at the South American weather, but it would make sense that if the Brazilian bean crop is there and we don't have corn and wheat to support these beans, it would make sense that the hogs and the soybeans would come back together again. Unfortunately, it may be a lower mindset, but we'll watch the HPAI. That's the other thing out there that has been keeping this protein market very uplifted.
Very true. Very true. All right. Final thoughts from you. Anything you would mention or reiterate to folks here today, Mike?
I would say the acreage numbers, we've traded a lot this week. What we haven't traded, Jesse, is the export demand that USDA gives us in the baseline or update, in the ag outlook, and especially those biofuel numbers. I think there's a lot of nervous energy traders out there right now for both bean oil and corn ethanol. And so we really need to see some good numbers in that.
All right, Mike, if folks want to reach out to you there at Global Commodity Analytics, what's the best way?
GlobalComResearch.com is the website. Get a 2-week free week trial on that, and be happy to contact you if you want to call the toll-free number.
GlobalComResearch.com, GlobalCom with 2 M's, research.com. Mike Zuzolo, Global Commodity Analytics. Always good to chat with you, my friend. Have a great week, and we will talk to you next week.
Thanks, Jesse. Have a great week, too.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.